And welcome again to my show, Searching for Integrity. My name really is John Smith, and I'm searching for people with integrity. Why? Because our country suffers from IDD, Integrity Deficit Disorder. Today, you have yours truly bringing you some very interesting interests in economics, financials, markets, things such as that. I thought the time for something to look at, to think about it. And then if you've been thinking about the same thing, you may want to be prepared as much as you can. I have the first one started off as one area where hiring is still strong, and that is housing construction. How you like that? And its first one picture is a picture of Phoenix and some of the construction going on there. I'm just 2 hours away from that in Tucson. The pace of job gains broadly slowed last month, adding 187,000 in July. Bureau of Labor Statistics data show housing continued to contribute to the gain. There were 7,800 jobs related to residential construction added, the data showed. It was the fourth consecutive month that the combined measure increased. While residential construction jobs increased on net, the gain came from a rise in the number of contractors. Residential specialty trade contractors jobs increased by over 13,000, while jobs were in residential building construction. A group the Bureau describes as those primarily responsible for the construction of buildings by 5,500. These numbers here, they're compared month to month, and that gives the analyst a good opportunity to look at as residential construction or not. And employment. Yep. 3.3 million in July broken down as 925,000 builders and 2.4 million residential trade contractors. Jobs in the financial services related to real estate also increased. The subsector, which includes jobs related to leasing real estate agents and brokers, and other real estate related activities, added 500 jobs in July. July's data is the latest to show the economic impact of the lack of homes for sale. Level of new listings measured by Redfin during the 4-week period ended July 30th was 21.3%, lower than 1 year prior, the brokerage said. Rising mortgage rates have cut down on both demand and supply. Buyers who are not out of the housing market have turned to home builders to help fill the void of available homes. Seasonally adjusted annual rate contract signings to purchase new homes was roughly 24% higher than 1 year prior in June, according to the census data. The builder confidence has also improved. Mortgage companies for sure are making it good because their rates have gone up as well, around 7%. And if people want to go buy, then they're going to have to find out where they're going to get some money to borrow to buy the construction, the single family. And I was looking at single family homes, I should say. That was interesting. I did. Um, Last week, I got some message over the news regarding stock markets. And I'm puzzled by the stock market surge. Overshoots are the new normal. Bank of America strategists offered that to us. Stocks have surged this year without really anything going right, besides the rolling out of error-prone artificial intelligence chatbots. That's the AI they're talking about in the news everywhere. Interest rates have surged to a 22-year high. Earnings are down from last year, and pandemic era savings are being drawn down, if not entirely exhausted. Strategist of Bank of America had an interesting theory. Asset price overshoots the new normal, they say. Certain items consider oil went from $37 in April 2020 to $123 a barrel in March 2022, then down to 67 the following 12 months, which was just recent. Scratch your head, you know. Bitcoin went from 5,000 in January 2020 to 68,000 in November 21, down to 16,000 a year later and up to 29,000 now. The S&P 500 went from 3,300 to 2,200 to 4,800 to 3,500 and then 4,600 thus far in the 2020s. AI is simply the new overshoot, most say, in the business. The S&P 500 has gained 18% this year, as the NASDAQ composite has rallied 34%. Hartnett and team noted the real retail sales, that is adjusted for inflation, which was conceded with recessions since 1967. Real retail sales falls in excess of 3% are associated with hard recessions. A bad sign, real estate sales are negative source. Federal Reserve Bank of St. Louis, seasonally adjusted. They have a factor that says recession. Historically, a 2 to 3 point rise in the savings rate also is necessary. And already it's risen from 3% to 4.6%. The unemployment rate so far hasn't risen, though a 0.5 to 0.1 rise in the jobless rate also is typically. As everyone punts for a soft landing into 2024, it would be so the 2020s for the economy to hit a brick wall. They like emerging market commodities as summer upside plays in credit and tech, as autumn downside plays. So that's a quick look at what we thought we didn't want to get, and now we got it, and that's a surprise. Repeating some of that in this next item, the Fed eventually will disappoint Wall Street and Main Street. The jobless rate fell back to 3.5% in July, matching the Helicon days in '69 when men first walked to the moon. If you ever doubted the markets are regular folks inhabit two different planets, consider the latest employment the report released this past Friday. The Bureau of Labor Statistics reported that the jobless rate fell back to 3.5% in July, matching the Helicon days in 1969 when men first walked on the moon. Payrolls expanded while hourly wages were up. Goldilocks combination of not too hot, not cold labor market. As economists see it at the time, Bank of America and JP Morgan have joined the list of forecasters that have canceled their recession calls for 2023. By the way, for all of you who know, I watched that on TV with the 1969 going to the moon. And that was in June or August, I believe, because I had just returned home from Vietnam. All right, John, stay on track. But the latest CNN poll, 51% of the respondents said the economy still is in a downturn and getting worse. Even worse for President Joe Biden's re-election prospects next year. His approval rating for handling the economy was 37%, and that was even lower than his overall approval rating, a dismal 41%. Those numbers were right in line with an array of other polls tracked by Real Clear Politics. Interesting, very interesting. Let's do the next. Some of these may not be exactly what you're going to think about. And as we get here, I'll probably be one of those, just like you are. A strange change in behavior without a clear explanation. This was what they were referring to in the previous item. August, the best month for average stock market performance, or is it the worst? The answer depends on the period of stock market history you examine over the 90 years from the Dow Jones Industrials inception, 0.43%. August on average was far ahead of the other months, more than 4 times larger, as you can see from the table below, which I'm unable to show you. Since 1986, in fact, August has been worse month for the stock market than even September, whose reputation for stock market losses is widely known. Yes, they have. In the 36 years since 1986, where all statisticians had to go on, they would conclude that August underperformance was significant at the 95% confidence level, just opposite of the conclusion that emerges from the 90 years prior. But then analyzing the Dow's entire history since 1896, August performance is no better or worse than average. That's pretty something. This August, in order to use history as a base for investing, you'll first need to come up with a plausible explanation of what changed in the 80s that caused August to swing from best to worst. Though I'm not aware of any such explanation, it's always impossible that it exists. To search for it, I analyzed monthly values back to 1900, economic policy uncertainty, EPU index. That's interesting. But no such change showed up in the data. August average EPU level is no different than any of the other months on the calendar, either before or after 1986. A plausible, possible explanation might trace to investor sentiment to investigate that possibility. I analyzed stock market timers average recommended equity exposure levels as measured by the Hulbert Stock Index. I was looking to see if after 1986 was significantly different at the beginning of August than another average. The answer is no. So a lot of these items and explanations that we thought we were going to hear have just not happened, have just not occurred. And coming upon us, it could be that we're waiting upon in order to prepare for those in the following way. It would be hardly be a surprise if randomness is the culprit. Most of the patterns that capture Wall Street's attention are in fact nothing more than statistical noise. The reason we nonetheless insist that a significant patterns exist is because, as numerous psychological studies have shown, we're hardwired to find patterns even in randomness. That's why you default reaction to all alleged patterns, not just those involving August. You should be skepticism. The odds are overwhelming that they aren't genuine. Only if these patterns can survive the scrutiny of a skeptical, can't get that one today, statistician, should you even begin to be interested. I think the message there was you might want to write and go to the sidelines just to see if you can get a direction of which way the market is going up or down. You know, there was one article here that the S&P 500 has seen a 2% daily drop in nearly 6 months. Does this mean a sell-off is overdue? Are stocks overdue for a wave of volatility? Here's what the historical data tells us. U.S. stock market has conspicuously calmed for most of the 2023, prompting some analysts to question whether investors might be overdue for a powerful jolt of volatility. It's been 113 trading sessions since S&P 500 and seen a daily drop of 2% or more. The longest such stretch was February 21, 2020, according to Dow Jones market data. The last time the large cap index fell by 2% or more than close was February 21, 2023, when the index dropped by 2% exactly. That was nearly 6 months ago. Such subdued volatility is perhaps the most pertinent indication of just how much has changed for markets since 2022. When measured by the total number of the 2% swings in either direction, last year was the most volatile for U.S. stocks since 2009. The S&P 500 recorded 46 daily swings of 2% or more in either direction last year, compared with 55 in 2009. Dow Jones data show. Of thus, roughly half were down days. This quiet streak has been good for stocks. Since February 21, the S&P 500 has gained nearly 13% according to FactSet data, and as of Thursday, it was up more than 18% for the year. But as August got us off into a rocky start with the S&P 500, that NASDAQ composite on track to finish lower for the first week of the month, following a 3-day streak of losses. some wondering if the market might be overdue for a large and perhaps more aggressive drop. To the extent that the market's past performance can tell investors anything useful about the future, historical data compiled by Dow Jones Market Data shows that streaks of relative calm have endured for much longer in the not too distant past, which is not. So it shows here that there's a lot of back and forth, a lot of positive and negative. It's as you look at your bank and your savings, you ask yourself, should I take a bit of that and roll the dice, if you will, by buying stocks or even buying bonds if you have a good person to deal with on that. I've looked and I've been out of the market for a considerable period of time. That's because I'm waiting for those items to be, I guess, heard and seen as much as I, and hopefully as much as you. I want to thank you today for listening about these financial articles. I know these are good information if you're into that, or if you're in your savings or more. And thank you, listeners, for tuning in to Searching for Integrity. So long and happy trails to all.